Everybody, hope you're well. Hope you're enjoying the summer, finding some time to rest and relax. Amazingly going quickly through the summer here, already in mid-August. Markets have been positive, a little bit choppier as expected, and as we outlined in the last couple of videos through these summer months, but continue to be positive and rallying off that March and April low. I've got a few charts here to show us what we're looking at going forward. So you can see here this going back to 1950 in a year post-election. So the year after an election in the US, this is the data. It's pulling that black line being the average return, and you can see the path forward there. The blue line being the current year. Of course, not starting at the exact same spot. You can see the black numbers on the right, blue numbers on the left. But what we're looking for is the correlation between those lines and the kind of seasonality of the returns. That yellow box, most importantly, showing the August, September, October period being the weakest of the returns, while November, December being some of the strongest returns. So one indicator that we might be in for a bit of a correction, or at least some volatility over the next couple months, as we've stated previously. One thing on the positive side to look at, a lot of negative news headlines out there and a lot of recession talk, but at the moment, there is a slowdown in the economic momentum right now, but no signs pointing to a recession. You can see that latest data point there ticking upwards again. So if we're in that blue or that green, no signs of a recession, we get into that yellow, red, we need to worry at that point for sure, but looking positive longer term, although in a slowing economic period at the moment. The S&P 500, here's a sign for the case for some of a correction right now in the markets. This is the price to sales. So the price of a stock on the ratio of the average sales, looking at all 500 S&P companies, you can see at 3.15 there, we're at the highest level we've seen, meaning that stocks are priced as high as they have been based on the amount of sales that these companies are creating. So two ways to get back from there, and not to say this number can't go higher, but two ways to get back to a bit of the median or the norm would be markets flatline and don't move up all that much in the short term, while companies continue to grow and increase their sales number. That will bring that price to sales number down, or of course a bit of a correction, bringing that 3.15 down much quicker with lower costs, lower prices of these stocks. So another reason to kind of be careful here as we move forward and potentially see a bit of a correction. But again, these companies are also having great earnings and sales numbers are increasing. So that's another way to normalize this number. Looking out longer term, and I've showed this chart before, this is the year that in a bull market, that third year where things are often choppy, potentially flatlining for a year until the bull market continues up. We of course haven't seen that this year, although we did start with that in April. We've seen the choppiness, but we've now recovered and began to rally again. And you can see that on that red line. Look at some of these others going back to the last 6 bull markets. You can see in the bull market of 2000 going 12 years strong. Not to say there weren't corrections and dips through that, as we've seen through this one, but there could be a lot more legs to go. But know that year 3 is often one where markets are flat or slightly negative as we move through and on to bigger and better things on the growth of a bull market. A couple quick charts to share with you that I thought were interesting. I showed you last week how much of a weight NVIDIA has. Add Microsoft to that, you're now at 15.4%. So 2 companies of the S&P 500 companies, just 2 of those are a 15.4% weighting. Never been that high for 2 companies before. And of course, as I mentioned previously, if you add a few more of those large tech companies, you're at 25 to 30% for just a handful of companies as the weighting for those top 500. So you may think you're diversified in the S&P 500, but if it's not equal weight between all those 500, then you're going to be overexposed to some of these large tech companies. Not to say it hasn't performed well for you, but just know that that diversification is becoming less and less as these large companies are taking a bigger and bigger percentage of the weighting of the S&P 500. One last one that I thought was interesting. This is the average rate change year over year in the US. And you can see going back into the pandemic, a drop in 2020 as people were trying to figure out what was going on. But then rates spiked up 18% year over year change in 2021 going through that pandemic. But you can see over the last few years here, the rate change is actually negative, meaning rents are actually dropping in the US. And in certain places, renting has become much more affordable than even buying and having a mortgage, partly because interest rates, especially in the US, have not dropped as quickly as they have here in Canada. So mortgages are more expensive and rents are getting cheaper. Just something I thought was interesting, something to look at. So I'll share a few more market-related charts and a few more I find interesting in future videos. Any questions, as always, feel free to reach out. I look forward to connecting. Until next time, take care and enjoy the rest of the summer.